Welcome back to the deep dive. It is Wednesday, January 21st, 2026. And I have to say, if you made the mistake of checking your portfolio before your coffee this morning, I sincerely apologize.
Yeah, it's definitely one of those mornings where you want to just close the laptop and maybe go for a very, very long walk.
Well, walk is not going to fix this chart. We are looking at a classic split-screen reality today, and frankly, it is giving me whiplash. On the left side of the screen, you've got the World Economic Forum in Davos. The reports we have in front of us paint a picture of, well, victory. The vibe is mature, it's serious, surprisingly optimistic even.
It really is. It sounds like the financial adults have finally, taken over the crypto playroom.
That's a good way to put it. The Wild West era is effectively dead in those boardrooms.
Seems to be.
But then you glance over at the right side of the screen, and the markets are just hemorrhaging red ink. Bitcoin has plummeted from, nearly $95,000 down to about $88,000.
In a matter of hours.
And not because an exchange blew up or there was a hack. It's because of a trade war involving President Trump, Emmanuel Macron, and, of all places, Greenland.
It is the ultimate paradox. I mean, we are seeing the highest level of structural adoption in the history of the industry.
Right.
Happening at the exact same moment the geopolitical floor is falling out from under us.
So that's our mission today. We're going to try to make sense of this cognitive dissonance. We've got a stack of reports from Davos, some analysis from finance magnates and 99 Bitcoins, and some really interesting press releases about an experiment in Bermuda.
A big one, yeah.
We need to figure out, how can crypto be winning the war for infrastructure while getting absolutely crushed on the battlefield of price?
Well, it comes down to distinguishing between the plumbing of the global economy and the hurricane that's raging outside the house.
Okay.
The plumbing has never been better. The weather is catastrophic.
Let's start with the plumbing then. Let's go to Davos. If you rewind just 12 months to January 2025, the conversation there was completely different, wasn't it?
Oh, it was night and day. I actually went back and looked at the 2025 agenda to compare. Last year, the headline session was Crypto at a Crossroads. It was so existential, the panelists were debating if the industry was dangerous, if it was a bubble, if it should be banned.
Very theoretical, defensive.
Exactly. And this year,
What's on the agenda now?
the existential dread is it's gone. The 2026 agenda is hyper-practical. You've got sessions like, is tokenization the future? And where are we on stablecoins?
Note the phrasing there.
Right. They're not asking if stablecoins are going to stick around. They are asking, okay, how do we integrate this into our settlement layer by Q3?
That feels like a massive shift from philosophy to engineering.
Yeah.
But does practical just mean boring? Because usually when Wall Street gets involved, they strip out all the fun.
And the volatility traders love, yeah. But in this context, boring is exactly what you want.
Okay.
When you have the CEO of Euroclear, remember, they settled quadrillions of euros in securities, sitting on a panel, they aren't talking about going to the moon. They're talking about capital efficiency. They're talking about reducing settlement times from T+2 down to T+0.
Let's unpack that for a second. Capital efficiency is a great buzzword, but why does a giant like BlackRock or Euroclear actually care about tokenization? Is it really just to save a few pennies on fees?
It's about unlocking trapped capital. In the traditional system, when you trade an asset, your money is tied up for days, just clearing through intermediaries. That's dead money.
It's just sitting in a pipe somewhere.
Precisely. It's not earning yield. If you tokenize that asset and settle it instantly on a blockchain, that liquidity is available immediately. For a firm managing trillions, that efficiency is worth billions of dollars a year.
So it's not about the technology being cool. It's about the velocity of money.
That's it. And that's why we're seeing companies like PayPal and Euroclear moving past the press release phase. They are deep in operational testing.
Figuring out the nuts and bolts.
Yeah, custody, governance. They're trying to make the blockchain boring enough to trust with pension funds.
Speaking of trust, I noticed a lot of chatter about stablecoins this year. Usually, stablecoins are just the poker chips traders use to move in and out of Bitcoin. Has that narrative changed?
Dramatically. The CFOs at Davos are looking at stablecoins as a treasury tool.
How so?
Well, if you're a multinational corporation, moving money across borders through the old SWIFT system is slow, it's expensive, it's opaque.
Right. You send money on a Friday, maybe it arrives Tuesday.
And the fees are a mystery until it lands. With stablecoins, you send USDC or a euro-backed token, it arrives in seconds, and the cost is negligible. It's becoming a settlement layer for global business.
Okay, so the suits are happy, the infrastructure is being built, But it wasn't all polite nodding and agreement at Davos, was it? I saw some clips of a panel that looked a little heated.
Ah, you must be referring to the heavyweight bout between Brian Armstrong, the CEO of Coinbase, and Francois Villeroy de Gallo.
The governor of the Bank of France.
That's the one. It felt like a clash of civilizations.
It really did. And it's important because usually the World Economic Forum tries to, sanitize these debates. They love to talk about blockchain technology because it's neutral. But they let this one happen on the main stage. The debate about monetary sovereignty.
So what was the core disagreement?
Villeroy de Gallo took the classic central banker stance. He argued that sovereign institutions, central banks, are the only legitimate issuers of money because they have a democratic mandate.
Okay.
His argument is we trust the euro because we trust the institutions that back it, and those institutions are accountable to the people.
And I have to play devil's advocate here. He kind of has a point, doesn't he? I mean, if the euro collapses or if the Fed screws up, I can theoretically vote out the government responsible. If Bitcoin crashes or the code breaks, who do I call? There's no customer service line for the blockchain.
That's the traditional argument. But Armstrong just flipped that logic on its head. He didn't argue about customer service. He argued about control.
He said Bitcoin is more independent and more legitimate, specifically because no one controls it. His quote was, "No country, company, or individual controls it."
So he's saying that democratic mandate is actually just a polite way of saying political manipulation.
He's reframing the risk. He's arguing that in a world where central banks can debase currency to fund deficits or fight trade wars, the math of Bitcoin is a safer bet than the mandate of a politician.
He shifted the debate from who has permission to who has the keys.
Exactly. And this isn't happening in a vacuum. The U.S. government seems to have swung toward Armstrong's side of the argument recently.
Yeah, we've had a flurry of regulation that would have seemed impossible a few years ago.
The U.S. has done a complete 180. A few years ago, the regulatory environment was hostile, or at best is confusing. Now, with the passage of the Genius Act, the U.S. is looking like the adult in the room.
The Genius Act. Congress really does love a strained acronym. Strip away the branding for me. What does this law actually do?
It provided the one thing the industry was desperate for, a federal framework for stablecoins. And what does that mean in practice?
It mandates that issuers must hold one-to-one reserves in low-risk assets, like U.S. Treasuries or cash.
So it prevents a repeat of those algorithmic disasters we saw in the past. No more, trust me, the math works. You actually have to show the money.
You have to show the money. It aligns the U.S. with Europe's MiCA regulation. That's the Markets and Crypto Assets Framework, which was the previous gold standard. It legitimizes stablecoins as digital dollars.
And that legitimacy, that clarity, that's what opened the floodgates for things like this strategic Bitcoin reserve and the 401k access, right?
The 401k access in August 2025 was the tipping point. Once the Department of Labor gave the green light for crypto and retirement accounts, it unlocked massive pools of passive capital,
which led to all the ETFs.
We now have over 100 crypto-linked ETFs and ETNs exchange-traded notes.
Quick pause there. For the listener who isn't a financial analyst, what's the functional difference between an ETF and an ETN in this context? Functionally, for the average buyer, they feel very similar. You buy them on the stock market. But an ETF holds the actual Bitcoin. An ETN is more like a debt note from the issuer that just tracks the price.
But the key is that both exist.
The market is just saturated with access points now.
So we have access, we have rules, we have reserves. But I'm seeing notes here about another act, the Clarity Act. Is this just more good news?
Well, this is where the plot thickens a bit. Armstrong pointed this out at Davos. The big banks are lobbying hard against the Clarity Act.
Why?
While they're happy to use the technology for their own back-end plumbing, they're trying to build regulatory moats to stop crypto-native companies from competing with them directly.
Ah, classic incumbent behavior. We love the innovation, we just don't like the competitors.
It's the innovator's dilemma playing out in Congress. They want to tokenize deposits, but they don't want Coinbase to become a bank.
Okay, so we have the high-level boardroom battles and the legislative maneuvering. But let's zoom in on something tangible. You mentioned a national experiment in Bermuda. This sounds a bit like a PR stunt.
Come to Bermuda, the crypto island.
Yeah, exactly. But you think there's real substance here?
I do. This is one of the most fascinating stories of the week, I think. The government of Bermuda, partnering with Circle and Coinbase, is transitioning to become the world's first fully on-chain national economy.
That sounds like a headline from a sci-fi novel.
Yeah.
What does a fully on-chain economy actually look like for a regular person living in Hamilton?
It means crypto stops being a speculative asset, and it becomes the rails for daily life. You're paying your taxes in USDC. You're buying groceries with a digital wallet. You pay for your coffee on-chain.
Britt, why? I have a credit card. It works fine. Why do I need a blockchain to buy a sandwich?
Because for an island economy like Bermuda, your credit card actually doesn't work that fine. It's incredibly expensive. Yeah, between the card networks, the foreign transaction fees, the correspondent banks, local merchants are losing 3 to 4% on every single swipe. That's a massive tax on the local economy.
So this is an efficiency play again. It's about cutting out the middlemen.
It's about unit economics. If you can settle that coffee transaction for a fraction of a cent using a stablecoin, the merchant keeps their margin. And to kickstart this, they didn't just build the tech.
What did they do?
They stimulated the economy. At the Bermuda Digital Finance Forum, they actually airdropped 100 USDC to every single attendee.
Okay, airdrop is crypto speak for sending tokens to a wallet, but this was the government sanctioning it.
Government sanctioned, yeah. But think of it less like free money and more like a targeted economic stimulus. The catch was you could only spend it at local merchants who were onboarded to the system.
So they bootstrap the demand and the supply at the same time?
Simultaneously. It's a beta test disguised as a lunch voucher.
That is clever.
Yeah. And it worked. So now they're expanding it for the May 2026 forum. They're proving you can run a national economy on these rails, not for ideological reasons, but because it's just cheaper and faster.
So let's take stock for a moment. We have the plumbing fixed at Davos. We have the U.S. government passing the Genius Act. We have Bermuda running an on-chain economy. Structurally, it sounds like crypto has won.
Structurally, yes.
So why, in the name of all that is holy, is Bitcoin trading at $88,000? We were pushing 100 grand not that long ago. If the news is so good, why is the chart so ugly?
Because markets are allergic to uncertainty. And right now, we are staring down the barrel of a geopolitical crisis that makes all this financial news look, frankly, irrelevant.
This brings us back to the Greenland headline. When I saw Trump, Macron, and Greenland in the same sentence, I assumed it was a parody. Break this down for us.
It sounds absurd, but the strategic implications are deadly serious. President Trump has renewed his push to acquire Greenland. And we have to look at the map here. This isn't just about real estate. This is about the Arctic. It's about new shipping routes, and it's about massive deposits of rare earth minerals that are critical for tech and defense.
So he views it as a strategic asset, like buying Louisiana from the French. And I'm guessing Europe didn't just say, sure, make us an offer.
Europe is furious. They see it as an infringement on Danish sovereignty on European territory. The diplomatic fallout was instant.
And the U.S. response?
They announced a 10% tariff on major European economies, France, Germany, the UK, Denmark, starting February 1st. And the threat is that this ramps up to 25% by June.
That is a massive blow to global trade. That's recession territory.
It is. And the EU isn't sitting back. President Macron is at Davos right now, threatening to use the EU's anti-coercion instrument.
Which the media is calling?
The trade bazooka.
Trade bazooka. It sounds like something from a bad 80s action movie. But I assume the economic impact is real.
It's very real. This instrument lets the EU impose countermeasures, tariffs, trade restrictions without needing unanimous approval. It's a fast-track weapon for trade wars. So you have the two largest economic blocs in the world unlocking the safety on their economic artillery.
And when the elephants fight, the grass gets trampled. In this case, the grass is my portfolio.
Investors are fleeing to safety, and this is the crucial point. Despite all the talk of Bitcoin being digital gold, in a moment of acute liquidity crisis, it still behaves like a risk asset. When people are terrified of a trade war, they sell everything that isn't the U.S. dollar or physical gold bars.
So the structural maturity we talked about, the ETFs, the settlement layers, none of that matters in the short term.
In the short term, liquidity trumps structure. If you need cash to cover margin calls, you sell your most liquid assets. Crypto is liquid, so it gets sold.
And now everyone is just waiting for Trump's speech later today at Davos.
The market is completely paralyzed. Trump has a history of unscripted remarks. If he doubles down on this, we could see Bitcoin break below 85K. If he signals a deal, we could see a massive relief rally.
It really is a tale of two realities. On one hand, you have this slow, steady march of technological integration. It's boring, reliable, efficient. On the other hand, you have a geopolitical reality show that is setting the furniture on fire.
And that is the tension of 2026. The how of crypto has been solved. The if is gone. But the when is being held hostage by old world politics.
You know, this brings up a thought that's been nagging at me since we discussed the Armstrong versus Villeroy debate.
What's that?
We talked about Armstrong's claim that Bitcoin is independent, that no one controls it. And usually when we talk about risk in crypto, we talk about volatility.
Right.
The price crashing 10% in a day.
Crypto is risky because it's volatile. That's the standard line.
But look at what's causing the crash today. It isn't the code. It's not the blockchain. It's two world leaders threatening to blow up the global trade order over an island in the Arctic.
The dollar and the euro are being weaponized.
Exactly. So my question is, where is the real risk located? We're conditioned to think the volatility of Bitcoin is dangerous. But isn't the volatility of political whims actually more dangerous?
I see where you're going.
Bitcoin might crash because of fear, but it won't crash because a president woke up on the wrong side of the bed and decided to buy Greenland.
That's a profound realization. In a world of trade bazookas and weaponized tariffs, an asset that simply follows a mathematical schedule, it starts to look less like a casino chip and more like a sanctuary.
The price is volatile.
But the policy of Bitcoin never changes.
The issuance is the issuance. 21 million, no matter who owns Greenland.
The issuance is the issuance. And perhaps that's why, despite the sea of red on the charts today, the mood in the back rooms at Davos is so confident. They know that eventually, the noise of the trade war will fade, but the signal of the technology will remain.
Well, on that note, we are going to wrap it up. I'd suggest keeping your eyes on the news feed for that speech later today. It's probably going to move the markets one way or another.
And maybe check the flight prices to Bermuda. I hear the on-chain economy is lovely this time of year.
I'm already packing my bags. Thanks for listening to The Deep Dive. We'll see you next time.